Hi, welcome to Let's Talk Bonds, presented by INR Bonds. I'm Arjun Patsati. The podcast is largely on the Indian bond market and all the relevant factors that determine that drive the Indian bond market. And a lot of things have been happening in the Indian bond markets in the recent times. The first is that the Indian government bonds have been included in the global bond index, and as of June end, 1% was added on to the JP Morgan index. So there is a lot of expectations that bond flows from foreign investors as they rebalance their index holdings flow into Indian bond market, Indian GSEC specifically, and that is expected to add more flows into the Indian market. That is the biggest news for last month, but again, many more are there. But let's first go to the news that is actually driving the global bond markets. The Fed in their last meeting guided for 4 rate cuts in calendar year 2025 and 1 rate cut in calendar year 2024 that could happen towards the end of the year. Most probably, it will happen after the US elections in November. But it could happen earlier, really depending on how the Fed views the economy. And now this is driving a lot of chatter on what can it be its impact on bond markets across the globe. In the other central bank actions, we already saw the ECB, the Bank of England, and the Bank of Canada reducing rates by 25 basis points. And all this is coming after a long period of rate hikes, where on the back of inflation running at very high levels across the economies. And now with inflation down, and many economies are a little worried about what all the things that are happening across the globe, both geopolitically and politically. And they are worried about the demand factors affecting in their own countries. And they believe that rates could be too high and could affect demand and impact growth. If you look at the Fed, the US economy data, it's pretty positive in terms of the job market is extremely strong. Wage growth is pretty high. And inflation, though it's come down, it's still at over 2%, well over 2%, which is the Fed's target level. But the Fed believes that going into the end of this year and next year, inflation could cool down. And because of its rate hikes previously, the economy could see some faltering. And this would mean that they could have the leeway to reduce the rates. But having said that, even if they reduce the rates by 125 basis points, it will only come down to around 375 to 4% levels. And you have to remember that just after the COVID, they took the rates down to 0%. So we are seeing a new structural rate, which is across the globe. We don't see rates coming off very sharply, largely because of the fact that global economies that have been seeing inflation at very, very low levels for almost 2 decades have suddenly had to face very high inflation levels. And this is really unnerved both the governments and the central banks. So we are not going to see in a hurry to 0% rates again. And it's had very bad impact on the bond markets. Global government bonds have even seen prices fall by 50% in some of the economies like Austria. Eurozone bonds have really tanked in terms of prices, and even US treasuries have tanked. So now central banks are going to be very, very watchful on how much they can reduce rates. So I would suspect the new normal would be closer to 4%, maybe in a 3 to 4% range, definitely not below that. So in coming to India, we saw the government going through the elections, and the NDA government has again come back to power. But what the feeling is, especially going into the full budget for 24-25, which is to be presented in July this month, the government will start to spend a little more on the agrarian economy, especially through subsidies and many other freebies, you can call it, or enticements to the rural population, where and this could mean that the government would be spending more. And where would this money come from? Can it come from the budget itself in terms of higher fiscal deficit? That's a question mark bond markets are asking. And so that's one question that we need to address in this podcast as well. And obviously, what are these what will RBI also? Will RBI follow the Fed? And in the last monetary committee meeting of the RBI, they clearly said that they are not going to follow the Fed, whatever the Fed does. But does that mean that they will not follow the Fed? Looks maybe on again, we'll address this as we get into this podcast as we go along. And all these impact Fed, budget, and RBI impact on G-Secs and corporate bonds. So that is what the podcast will cover. And if you're new to INR Bonds, do follow us on all podcast channels, including YouTube. And to get podcasts like this, INR Bonds is an online bond platform provider, providing the best bonds at the best prices with the most information for investors. And we provide the best transaction experience as well. So everything put together, if you are an investor looking to invest in bonds, INR Bonds is a platform for you to look at. We are a SEBI registered bond platform. Getting back to the podcast. So we have the Fed now looking to cut rates. Yeah. The budget itself, like I said earlier, there is a question mark on how much the government will spend and where will they get the money from. The RBI had given a dividend, a bumper dividend to the government this year. Over 1 lakh crores was given to the government more. That is, normally they gave 1 lakh crores. This year they gave 2 lakh crores. So government does have excess funds right now. And also in the last 3 months, tax collections have been extremely good. And the government has not spent any money because of the elections. So once the budget is passed, the government is going to spend all this money in a hurry. So while they will try to strike a balance between keeping the fiscal deficit in at the budgeted levels they budgeted in February, they're not going to go down below that in a hurry. And they will also strike a balance between funding the capacity, increasing the capacity in the country through capital expenditure, and also strike a balance between providing the right amount of the support to the rural economy in whatever form or the other. So that seems to be the agenda for the government. So at this point of time, we do not see any increase in government borrowing, which is actually lower than last year. And with status quo, with higher spending, where liquidity is going to increase, and more demand for government bonds because of the JP Morgan inclusion in global bond index. The borrowing should be taken up without any hitch and RBI is not likely to have to intervene in the market to actually support government bonds. The only intervention they need to do is maybe to see if yields go down too fast, then they may come out with some sales of government bonds. to match a demand supply mismatch. On the RBI front, they're not likely to reduce rates soon, but going into the beginning of next year or half of next year, from levels of 6.5%, they could reduce the repo rate by 50 basis points to 6%. To a large extent, government bond yields, if you look at the government bond yield curve, the 10, 15, and 30-year bonds are almost at same levels, including the 5-year bond as well. So what the market is clearly saying is that the long bonds are expecting the short-end rates to fall. So that is an expectation by the market. And with such strong expectations, normally we do see that that RBI does come and cut rates. The timing is something that is subject to debate in that sense. So what is the impact? What is going to be this impact on government bonds going forward? While long bond yields have already come down, there is some scope for yields for continuing to fall. And there could be a steepening in the yield curve with short-term 3 and 5-year government bond yields falling faster than the long-term government bond yields. So there is gains to be made across the yield curve if inflation stick to its falling trajectory, both in India and globally, and no other external shocks or internal shocks come about. So, and on the corporate bond side, with a lot of liquidity that is going to happen in July, going into July and going forward, there is going to be a demand for higher yielding corporate bonds. And this could drive down corporate bond spreads. And so that is largely the impact, not to be felt as just tomorrow or day after, but over a 1 to 2 year period. So at least at this point of time, if you look at the whole macro picture, the outlook for bond markets are highly positive, as seen by the yield curves as well, which reflects the market behavior, as also the fact that guidance of central banks, including the Fed. So thank you very much for listening in, and do reach out to us if you have any comments, queries, etc. And as mentioned, do follow us on all podcast channels, and do visit INRBonds.com to check the best bonds on offer with the best information and the best prices.